that. Thanks for catching me so early. Yeah. So my name is Garrett Wood. I am an investment broker at Foresite Commercial Real Estate, San Antonio. I appreciate the introduction for the CCIM group having me on today to speak about retail. I look forward to helping everyone get a somewhat clearer picture of how the pandemic has affected retail real estate and to see what we may expect as we move forward into 2021. So what I love about retail properties is that we all see them in person every day, and most of us walk into at least one retail or restaurant-related property each day as well. And so, a great thing that I enjoy about working in the retail sector is it can relate with other people who aren't in commercial real estate. We can talk about tenants, we can talk about properties because they're so visible. But unfortunately, since retail and restaurant properties are so visible to the consumer and rely heavily on foot traffic, it's been one of the hardest hit segments in from the pandemic, and especially those were forced to close down by the government mandated shutdowns. And speaking of government mandated shutdowns, when COVID hit, most local and state governments began deeming businesses as essential versus non-essential. And as we can see in the group on the right, a list of businesses that were considered non-essential. Unfortunately, these businesses have faced the biggest impact in terms of their sales volume from COVID, and they are most likely the ones that are going to take the biggest hit in terms of the length of recovery time ahead. Now, this graph shows a retail store sales by segment in terms of April 2020 versus April 2019. And as we can see, the group that was hit hardest was specialty soft goods, which consist of clothing stores and boutique, small shop stores. And, they were deemed non-essential from the get-go and had to close temporarily. You see on the top, the graph or the bar in green shows food, and this is related to grocery stores. And we all experienced in April going to the grocery store to go stock up lots of groceries because we didn't know what to expect. And so grocery stores saw a huge increase in sales year over year during the pandemic. The very bottom of the graph, you see the other green bar, 21% is internet sales. So non-store retailers, they jumped substantially during COVID. Now, fast forwarding to August of this year, and we see that the store segments are all beginning to recover. And this is a reflection on lifting of occupancy levels. And when we combine these segments in total, we can see that the total retail sales volume is down only 0.2% for August, which is a sign that there's still healthy spending out there. There's a strong consumer desire to buy things, and that's great for retail. But we can look at the very bottom and see that non-store, so online-only retailers are still grabbing a big portion of that market share of total retail sales. Now, Walmart is an interesting case study from COVID. We oftentimes think of Walmart as the biggest brick and mortar retailer, and it is, but they have really ramped up their e-commerce platform, so online sales over the past few years. And it really paid off for them during the pandemic because they had that platform established and they were able to offer online grocery orders and curbside pickup, as well as they compete head-to-head now with Amazon in terms of being able to buy things online. And so they saw e-commerce sales grow by 97% from May through July. Best Buy is another major retailer that has many physical locations. They've adapted to the changing consumer behaviors many years ago and established a good online presence. And as we can see, that paid off for them during the pandemic. They became non-essential, and so they had to close all of their doors, and most of their stores were closed for a good 2 months during the pandemic. And the only resort that their customers had was to go shop online. And so you see that huge 242% increase in online sales. However, their CEO mentioned in their earnings report that as Best Buy's physical stores begin to open, each week they saw an increase in total sales volume combined. That's brick and mortar sales and online. And so what that tells me is that the brick and mortar locations have a big impact in terms of total company growth and sales volume growth. And so moving on from that, we look at bars and restaurants. We all have, seen the impact on restaurant and bars because many of us have not attended them near as much as we used to, especially during March through May. And, it took a multi-billion-dollar hit in those 3 months that we were locked down, but it's gradually recovered pretty well. We're still about $10 billion below where we were a year ago in terms of total restaurant sales per month. And this is mainly due to drinking places, so bars that are still not able to open in many states. So I hate to say it, as a consumer, I had to ramp up my e-commerce shopping this year. And I have been really reluctant and not a quick adopter of online shopping because I personally, as a young person, I like to go to the store. I'm known for making like 5 trips to Lowe's on a weekend because it doesn't bother me. I just like making trips to Lowe's and getting things that I need from the house. But as we can see from this graph, e-commerce sales as a percentage of total retail was really kicked into overdrive, as Yesenia mentioned earlier. And in the second quarter of this year, it grew in 3 months as much as it took, or as much as it grew in 10 years prior. So e-commerce penetration of total retail sales in the United States skyrocketed because of COVID. Now, we look at retail store closures versus openings, and through October this year, we've had around 8,000 stores closed. And we had about the same amount for the whole year of 2019. However, the big difference here is when we look at store openings. So in 2019, openings greatly outweighed closings. But in 2020, openings have been less than half of the amount of store closings. And so this is a direct reflection, I believe, on many tenants that are hitting the brakes on store expansion this year because of the impact that COVID's had. And I hear this in the leasing market with our leasing team that so many retailers had to hit the brakes this year. And so unfortunately, we're going to see a lot more closings versus openings in 2020. Now, I assume most of us have shopped at least a couple of these stores here mentioned on the left column. But unfortunately, these guys who we have all seen closing their doors recently had financial troubles prior to COVID. So COVID wasn't the main reason that these guys closed. A lot of them had huge amounts of debt outstanding. And then when they were unable to pay their debt and pay their rent, they had to file for bankruptcy. And so, as you can see, Bell's, Pier 1, and Steinmart, those are the ones that file for Chapter 11 bankruptcy, and they're going away. They're shutting all their stores down. Tuesday Morning is not shutting all their stores down. But this is a snapshot of San Antonio and Austin, and how just a few tenants who are closing their doors can affect the total square footage that becomes dark from a result of COVID. And so out of these retailers, around 29 physical locations will close, adding up to around 575,000 square feet in the Austin and San Antonio market. And many of these haven't, so this hasn't really registered in our occupancy right now because so many of them have just now closed their doors within the past couple of weeks. So as far as San Antonio goes, we saw retail vacancy rates hover around the mid 5% range, as Yesenia mentioned. I think that we'll likely see the vacancy rate increase quite a bit more in both San Antonio and Austin as we go into the fourth quarter, and especially in the first quarter of 2021, because some of those big vacancies that I just mentioned with those stores going out of business will start to register in terms of the amount of square footage online that's available. And when vacancy rates increase, we typically can expect rental rates to decrease. And as you can see on the graph on the right, the average asking rental rate for retail in both San Antonio and Austin has started to trickle down quite a bit. And it's very possible that it will continue on that pattern for the next few months. In terms of shopping center transactions in San Antonio and Austin, it's definitely been a hard year for retail investment sales. The number of new listings and deals that went under contract in the quarter of 2020 was substantially smaller than that of 2019. We can see a 67% decrease. I think there's been a lot of hesitancy from investors to bring their deals to market, mainly because of the factors of uncertainty and also taking care of their tenants and making sure their assets are stabilized and tenants are back to being able to pay rent. There also seems to be a big bid-ask spread between buyers and sellers, and I think that's what's kind of kept things at a gridlock for the past few months. And that indicates that buyers are looking for more yield and maybe more risk adverse, and sellers may not be ready to adjust to that. So here we look at the averages from around 50 shopping centers, shopping center transactions that our team has tracked over the trailing 12 months. And we can see that the biggest takeaways are that cap rates have increased by around 50 basis points in both San Antonio and Austin compared to the trailing 12 months at the end of the quarter 3 of 2019. And, you know, both markets have also seen a hit as a result of an uptick in cap rates on the price per square foot. And so you can see that San Antonio had a decrease in the quarter, or the trailing 12 months of Q3 by about 8.5%. So as most of you guys know, cap rates and prices are directly related to the debt market. For retail investment properties, what's happened since COVID hit, and what I've gathered from lenders and investors, is that you know, lenders have become extra cautious with lending on retail assets, and they're scrutinizing them like never before. From a lending standpoint, those assets that are heavily weighted with fitness, casual dine, and entertainment type tenants that occupy large spaces are very unlikely to obtain decent debt right now. And lenders want to understand the whole picture of how tenants perform in the worst part of the shutdown. So they want to know how much rent concessions were given, what the store sales were like for each tenant. And so it really slows down the lending capability for retail, unfortunately. And it just depends on the tenant, or the tenants, and it depends on the asset type. So Class A retail, a strong, you know, good real estate location for a shopping center still can obtain good quality debt at the moment. But again, it all comes down to the tenant mix. So our team conducted a survey with a group of nationwide retail investors in the third quarter of this year. Most of them believe that it's going to take at least a year, if not 2 years, to recover to where we were before COVID in the retail market. Thankfully, what we've seen when businesses are able to reopen, people are still motivated to shop and to dine. So the numbers have trended up since the greatest impact of COVID during April and May. But there will be a longer term impact on the market because of the amount of store closures, the extra precautions that tenants have to make, and then the changing lending environment and consumer environment. So with that being said, you know, I am still optimistic about retail and restaurant properties because of the pent-up demand that is just waiting to get out of the bubble and go spend some money out there. So in my mind, retail and restaurant assets are and will continue to be a great investment, great properties to own, and also great places to do business out of for tenants to operate. And with that being said, I want to thank everybody for their time and to just stay optimistic because we're going to get through this. And I believe 2021 is going to be a much better year for retail. Thank you.